Welcome to our channel, and more importantly, welcome to another educational episode. In this episode, we will be doing a deep dive into market cycles and using that knowledge to determine where we are in the current market cycle so that we can find long-term targets for the market. Everything I'll be discussing in this video is a function of my own opinion based on the research and quantitative analysis I have done in analyzing the markets. Stick around to the end of this video and remember to drop a thumbs up on the video and subscribe to our channel if you like the content. Also remember to turn on your channel notifications so that you are notified every time we upload a video. Follow us on social media to keep up with our educational content and so that you never miss any important market news. All important links to our channel are in the description below. So let's get right into it. To begin, I'm going to start by saying that there are so many variables that can cause a market to move higher or lower, but there's one thing for sure. The primary factor is that we're dealing with people who have all different types of emotions and don't necessarily think rationally. As a result, this makes markets very irrational, just like the people who are driving them. But what analysts have done is found similarities between how markets behave in relation to how people are feeling, which is essentially investor sentiment or investor confidence at any particular point in time. As a result, they were able to find that markets follow a specific pattern in one form or another, and this pattern is called the market cycle. And if we take a look at our screen, we can see a visual representation of this pattern called the market cycle. This market cycle is broken up into 4 separate phases. The first phase, the stealth phase, is essentially where all the smart money, which is all your private investors and your analysts who just want to get their own money involved in the market. Then we have the takeoff of the bull market, at which point we enter the awareness phase, which is where all your institutional investors, like your hedge funds, your private equity funds, and your investment banks start to get involved. Now, in order to generate liquidity for themselves, there's a bear trap, which is essentially trapping people who are looking to go short in the markets, which uses that liquidity to drive the markets even higher. As the markets begin to surpass the first highs of the first sell-off, we get some media attention getting involved, which means the public starts to become more aware of the takeoff of the bull market, at which point we enter the mania phase. In the mania phase, we have exponential growth in price of the market, at which point we reach greed, delusion, and what this chart likes to call a new paradigm, which is essentially a euphoric feeling at the top of the markets. At the beginning of the blow-off phase, we have what you call a bull trap, which is the opposite of the bear trap, which is essentially there to trap people who are looking to go long the market, but instead it uses that liquidity to drive the markets even lower, back down to a fair value. Now that we've established exactly what the market cycle looks like in theory, let's take a look back in history and see how accurate that chart has been over time. So we're going to take a look at 2 separate boom and bust cycles, starting with the dot-com bubble. And what I've done is I've plotted the 4 various phases along the duration of that cycle, and I've superimposed our chart in this area so that we can use it for reference to see which phases we're talking about. So as you can see, we had around a 5-year stealth phase where there was very little growth in the markets between 1990 and 1995. But then as the institutional money started to get involved, the market started to rally even faster at the end of that period, finishing with our bear trap. Following our bear trap, we then got that exponential growth in the mania phase, which ended with our new paradigm and people being very greedy. And then around mid-2000, we had the blow-off phase, which lasted about 5 years. So we entered a 5-year bear market at that point. Let's also take a look at the housing bubble, which happened between about 2003 and 2009. So as you can see, we had very little growth in the stealth phase, which lasted around a year. And then moving into the awareness phase, we had sort of choppy price action, but still moving in an upwards direction with multiple bear traps happening along the way. Then in the mania phase that we entered in around 2006, and I specifically remember this, is that there was a lot of people in the markets and in the media saying that the housing market can never crash. And as a result, a lot of retail investors starting to pile their money, sending the markets exponentially higher, before in 2007 the housing market popped, causing us to enter the blow-off phase. And as you can see here, we have our bull trap, and we had the huge crash which followed that. So that's check number 2 for our market cycle chart. These are merely 2 examples where the market cycle chart holds up. We could also take a look back at the 1980 bull market as well as the 1920 bull market, which also follow these specific trends. I must note that we can't just use the market cycle chart in isolation to determine whether we should buy or sell, but rather we should use it as a guide in our analysis so that we can know approximately what point we are in the market cycle. No bull and bear markets are exactly the same. As we can see, we had multiple pullbacks in the awareness phase of the housing bubble. However, in the awareness phase of the dot-com bubble, we had a much steeper incline in price with less pullbacks. So it's important to consider the whole picture before making any decisions. As I mentioned earlier, there are many factors that contribute to investors buying into a specific market or selling their positions in that market. It's impossible to predict the bottoms or the tops of markets, but in our analysis, we can try and determine when it's a good time to either buy the market or sell it. You may have heard a lot of investors state that you should buy low and sell high, but there's no hard and fast rule to determine when exactly are the lows and when the highs will be. The market cycle chart simply makes it a little easier to determine, to a certain extent, where we are within that market cycle. And as Warren Buffett has always said, be fearful when others are greedy and be greedy when others are fearful. And in order to apply these principles that we've just gone through, we have to first determine where exactly in the market cycle we are currently sitting. But before I begin analyzing this, I must first note that we are currently sitting in very unprecedented times, and a lot of fundamental factors such as GDP, unemployment, mortgage delinquency rates, and so on that we would typically use to determine investor sentiment just simply have not been holding their typical weighting on the performance on the stock market. We have to remember the stock market is not the economy, and they are currently completely uncorrelated. It's the people that drive the markets, and people are irrational. So in order to profit, we must follow where the money is. And if you've been watching any of my previous videos, then you'll know that there's plenty of money to go around if we take a look at the graph of the money supply that's been injected into the economy ever since the start of the crisis. So if we're following where the money is, then we know that there's a lot of money in the markets right now. But before we take a deeper dive into exactly this portion of the rally, we have to take a look at what has occurred before over the past 9 years in order to determine just how fragile the current rally that we're seeing is right now. So as you can see, we had our stealth phase already, as well as our awareness phase, which ended with the bull trap here around 2015 to 2016, coincidentally with the 2016 presidential election, and then following that we started the mania phase. But we've been seeing some quite interesting price action happen here as we had this huge crash at the beginning of the year due to the pandemic, and I've made my own prediction on what I think exactly this price action here represents. If we zoom in a little closer to this price action, starting with the beginning of the mania phase, it's only logical for me to assume that we had the end of the mania phase around the 18th of February of this year, and that this severe correction that we saw was actually our blow off top phase. So if this holds correct, then this would be the fastest bear market that we've ever seen in history. And I'm going to drop down to the daily chart just so we can see it a little bit better. So even though this correction lasted less than 1 month, I still believe that this was our blow off top because we had the bull trap, which is a significant part of our blow off top phase, as well as we had the swift recovery of the market. And that if this is to be the end of the last market cycle, then this would suggest that this recent rally that we've seen is actually the beginning of the next market cycle. So if this is anything to go by, then that would mean that right now we're starting to see market cycles occur a lot faster than ever before. But there's a lot of reason to this that I'm going to go into a little bit later on in this video. And this philosophy would actually make sense because if you think about it, we've actually rallied around 1,300 points within less than 6 months of the bottom that we set in March. If we compared it back to what we did in the last phase of this market cycle, we can see that if we look at the bottom around December 2016, it took us almost 3 years to do that same gain that we did in less than 6 months. So the primary reason that I'm making this assumption is because we've seen such an aggressive rally happen so fast, and that we've surpassed the previous highs that we had set in the S&P 500. So this would lead me to conclude that we've already seen the stealth phase followed by the awareness phase, and that right now we've just seen the bull trap, and that there's a possibility that we could be heading significantly higher within the mania phase. But of course, this is only my prediction, and I must have some evidence to back it up. So let's talk about some factors that may be supporting this theory that I have of us traveling even higher. The first factor supporting our theory is that it's extremely likely that within the next few months we should see another stimulus bill being passed. And if you've been following my other videos, you'll know that I talk a lot about the stimulus talks and the fact that the stimulus talks will likely send the market higher. So if we take a look back in history to see the effect that stimulus has on the markets, we can see here every place that I have a green arrow is where we had direct stimulus injection from the Federal Reserve and the US government. So the clear trend is that every single time we have stimulus injection, without fail, the markets have traded higher. And the most apparent time that we saw where stimulus had a direct effect on the markets was during the lows that we saw in March. That basically the stimulus hopes fueled our rally to where we currently sit. So if we were to get another stimulus bill, say around December or January, then there's no doubt in my mind that this would fuel our rally straight past all-time highs and setting new highs in the market. The second factor to consider is that if we take a look at investor sentiment, the survey that ends this week, we can see that in recent times, more investors have become bullish on the market, but we still have an overwhelming amount of neutral and bearish investors that could potentially get converted to bullish. As a result, this tells me that there's a lot of money sitting on the sidelines waiting to invest in the market if it starts to go higher. We have to remember that a lot of people missed the recent rally that we just had because of fear. So a lot of them are hoping not to miss the next leg up, and so they'll probably be easily converted to bullish if the market starts to trade higher. Lastly, and probably the most important of the factors, is that we're getting closer and closer to a vaccine for the virus. And of course, you know that if we do get a vaccine, the investors will become hopeful that we'll return to some form of normalcy in our lives. And so that means people will start going back out and start spending once the vaccine's been distributed. So this gives investors a lot of hope that if the vaccine comes out pretty soon, that it will make them overwhelmingly bullish on the markets and likely send the markets even higher. But with that being said, nothing is guaranteed. This is just an educated guess. All we've done is look at the facts and made a judgment. Now that we've created a bias, we can look for potential entry opportunities on lower time frames so that we can take advantage just in case the market starts to take off. All in all, this concludes our video covering the market cycle as well as looking at a potential rally following some good news. Thank you to all who took the time to watch the video, and an even bigger thank you to those who made it to the end of this video. I aim to continue to develop these videos and bring high quality content to the channel. I release at least one educational video on the channel per week, in addition to my weekly market breakdown released every Sunday. If you haven't already, help us out by dropping a like on the video and subscribe to the channel so that you don't miss out on any of our future videos. Thanks and peace out.